It's actually being able to structure a deal and bring in capital.
Yes.
That's the genius.
That's
when you know how to do that, game over, right? Because now it doesn't really matter.
World is your oyster.
Veena, wouldn't it be amazing if we actually had a lawyer who could tell us the legalities of raising money?
I mean, what if we just snap our fingers? Do you think one would appear?
Let's try.
Let's try it.
What?
Well, hello.
Nick.
Ask and you shall receive.
So guys, Nick is a securities attorney. Now, normally securities attorneys have a suit and tie.
Yes.
Not shorts and Nikes.
Well, to be fair, we just snapped him into existence.
That's true.
So
He just appeared
maybe wasn't prepared.
from vacation, wherever he came from. Yeah. No, actually, Nick is out here with Veena in our home in Montana.
Yes.
And we've been doing this community camp. It's been amazing.
Yes.
And Nick is a securities attorney.
Yes.
And so first of all, Veena, why is that so important? I mean, why do you go on vacation with a securities attorney? It's kind of weird.
I basically like make him follow me around everywhere because I'm always talking about raising capital and I want to make sure people are doing it the right way. And, you know, staying out of jail is a nice perk of having a securities attorney on your team. So whenever you're raising capital, your first call has to be to your securities attorney. Like when you just have the idea of raising capital, you should be calling Nick.
So guys, if you don't know, there's a right way, there's a wrong way. It's a very important thing.
Yes.
Because if you do it wrong, there could be ramifications for that, right?
Yes.
So we want to make sure you keep your nose clean as you go out there and start raising capital. So Nick is going to talk about the do's and don'ts, what is okay, what is not okay, why it's okay. And I think Nick said before we started the video, people need to understand first how capital is viewed from a legal standpoint, right? So tell us why that's so important.
Yeah, I think a lot of times people kind of misunderstand, and when I tell them what I do, they say, "Oh, I don't need that. I'm not selling a security." And so a lot of people don't really understand what a security is.
Yes.
And so this stuff is very nuanced and confusing and all that. But one thing the SEC has done pretty well is to let us know exactly what a security is.
Okay,
and what is the SEC?
Yeah.
The SEC is the Securities and Exchange Commission. That's the people who are saying, hey, if you're selling a security, you got to do it the right way. And if not, we're going to nail the hammer down on you.
And that's a federal agency?
Yes, it's a federal agency.
Okay.
They deal with
So it's a big deal.
3 letters. So we know that, like, you know, IRS, SEC, FBI, CIA, we want to stay all off
like
all their lists.
Yeah, that's right. So what you're saying is you, first and foremost, you need to understand what a security is.
Yes.
Okay.
So the way that we do that is we use what's called the Howey test. Okay. And so we've got 4 things that we're looking at.
Howey.
What does Howey mean?
Howey, it's from a Supreme Court case. So it's Howey
Oh,
versus
So it's like a
Howey.
person, I guess.
So it's a person.
Okay.
And so they say, look, if we have an investment of money into a common enterprise with an expectation of profit, primarily from the work of someone else, then we have ourselves a security. So again, an investment of money into a common enterprise, an expectation of profit, primarily from the work of someone else, we are selling a security. But I can say that even simpler. Essentially, if you have a passive investor, you should be thinking, you know what, this either is or it might be a security. So if we got passive investors, we probably need to have a call with somebody who knows about this stuff.
And when you say passive, meaning they're giving you money for you to go do something with that money.
Yes.
That would be passive for them.
They're saying, I want to write you a check, and then I want you to write me bigger checks back. Yeah. And I don't want to do anything.
That's what we
The
mean by
bigger
passive.
checks back is the key operational word in this, just to be clear when you're raising capital.
Yeah.
So we were talking about a deal that I have right before we started recording. And I had said, like, hey, you can come in. I kind of told you what the projected returns were and how it would work very high level. But that would be selling a security, because if Jerry writes me a check for $1 million, right? And I say, hey, Jerry, I'm going to go put it into whatever deal I have going on, right? You're making an investment of $1 million, right? It's into a common enterprise, meaning that there's more than one person in the deal because I have multiple investors.
Well, what is it? So what's the definition of an enterprise? A business venture?
Essentially that, yeah. If you're just working together, multiple people.
Okay.
So it's a common enterprise. I think you're expecting me to make you a return on the $1 million. If not, I have so many deals that I can have you fund. It would be great.
Yeah. So there's an expected profit.
There's an expected profit. And it's based on someone else's work because you're not going to be managing the asset. I'm going to be managing it. So you're expecting to make the profit off of me working and managing the asset.
And that's a security.
That's a security. And do you have to meet all four or just one or two or three of them?
So you do have to meet all four of them. And so if you do meet all four of them, then you say, yes, I am selling a security, which means you either must register that security or have an exemption from registration.
Okay, so what does it take to register a security?
A whole lot of time, a whole lot of money, lots of disclosures, audited financials. It's a long process. And in the real estate game, typically that's actually not going to work out too well with the timelines that you guys have to deal with.
Okay, so
that's a problem then.
Okay, so we're selling a security and we have to register all securities that are being sold, but it doesn't work for real estate. So
yeah, you might as well leave now, guys.
Yeah, we're just that's what, you can't do it. Not possible.
The work's done here. So we said register or find an exemption. So that's where I come in. And that's how we work.
This is where real estate attorney Jeannie, securities attorney Jeannie comes up with.
Which, guys, by the way, can you leave a comment and thank Nick first for being here and being so willing to share, and Veena for paying for Nick to be here, right? Because Nick is a lawyer, right? And this is not
He's billing us.
And you're getting this information for free on YouTube, but Veena has graciously paid Nick to be here. So I hope you guys see the value in this content to be able to learn this information. So this is really amazing, Veena. Thank you so much.
You're welcome.
Please, guys, tell Veena that she's already doing it, whether you say thank you or not. But I'd like you to tell her thank you for that effort and for Nick being here. So
you know how people can actually thank me more than just leaving a
Give
comment?
You money?
No, actually, is when you go out and raise capital, do it the right way. Because here's what happens. One person does it wrong. Investors get hurt. Investors get scared. And then guess what? It's hard for people like me to go out and raise that capital.
So we're talking about exemptions?
Yes. So
is that the key?
We're selling the security. We don't want to register it. So what's our other option?
So our other option is we've got exemption. It's register or find an exemption. And so when you're in real estate, many times you're having to move a lot quicker. And so the registration process just is not going to work. And so exemptions are where we come in. And so what that is they're basically saying, okay, the Securities and Exchange Commission says you are selling a security, but if you follow these set of rules instead, we're not going to require you to register. And so there's plenty of different exemptions. And so that's why you want to work with somebody where you can talk through what your goals are and then see which exemptions apply and are going to be best for you to fit your goals.
Yeah. And how many are there? I mean, is it like dozens or is there a handful or?
Probably a dozen.
Okay.
There's a handful that are commonly used in real estate, but there's probably a dozen or more that are just overall exemptions.
So maybe we hit on some of the most common ones that qualify.
Yes.
That might be helpful. Or how do we help people understand that there's these exemptions and here's kind of maybe big picture what they are and why they're there. Maybe that's helpful.
Maybe we talk about the big four.
Okay.
There are four that work really well in real estate. And then of those four, there's really two that probably like 95% of people are going to use.
Okay.
So let's hit on let's go from like the least used to probably like the most used so we can spend more time talking about the Reg D exemption. So let's start with Reg A. Okay,
yeah. So Regulation A, this came from the Jobs Act in 2014. And this is often referred to as the baby IPO. If we think IPO, it's initial public offering. That's one of those registered securities. So if we think about the startup companies and things like that, we've heard that's what
Facebook had an IPO. Yeah. Uber had an IPO.
Going public. Yeah.
That's what people say like, oh, we're taking the company public. We're going public. That's what an IPO
and that's
is.
Now stock, right? When that happens, you trade shares.
Usually,
you sell shares.
Yes.
Yeah, so Reg A, we often call the lawyers, the nerds here.
I'm like, who's we? We don't do that. We do that.
My people do this. I refer to it as the baby IPO because with that one, you're going to have lots and lots of disclosures. You're going to have audited financials. They're going to dig into who are all the owners of this, how much are they getting compensated for, and there's just a lot of regulatory red tape. And so it's a long process and a pretty expensive process as well.
That's Reg A.
Reg A.
Yeah.
Okay, and how much does it cost and how long does it cost how much time does it cost and how much money does it cost to set it up?
So Reg A, you're probably looking at maybe at least a 6-month runway. and then probably minimum on the low end 50,000 to get it set up.
Wow. Okay, so Jerry, I don't know about you, but for me, like my deals, I can't take 6 months to close them. So
that disqualifies most deals.
yeah, so this is not really a great structure. Now there are use cases for it, but it's not a great structure for us to be using.
And if you're paying 50,000, like it better be a dang big deal to be paying that kind of cash to set it up.
Well,
right?
when you're adding zeros.
When you're adding zeros,
So,
maybe it's insignificant. But
on a $65 million raise, this is like a rounding error.
Yeah.
Right. 50,000 here, 100,000 here. It's not going to really move the needle of returns. It's not going to move the return to investors by having this chart.
But just that 6 month runway is
too
going to
much.
disqualify it for most real estate deals.
Why would someone want to use a Reg A?
So let's say that you've got a machine going, you've been doing it for a long time, hint, hint. I don't know if the Reg A would be best for you, but you've got a track record and you say, look, I have deal flow and I want to have capital available. Reg A is great because you can raise, depending on which one you use, you can raise either $20 million or $75 million in a 12-month period. And so when you find those deals, you can have that capital there ready to deploy right away versus finding the deal and saying, okay, now I've got to run and figure out how I'm going to find that money.
So you don't have to have the deal elected to start the Reg A?
Correct.
It's just a fund to then deploy into deals.
Exactly.
So that would make sense then.
Yeah.
That would be a way to where it would make sense.
How many hotels can you buy in Puerto Rico with $75 million?
Well, I mean, there's big hotels and small hotels. I mean,
Yeah.
El Conquistador is like, a 900 room hotel with a resort and everything else.
So you can't even buy that with $75 million.
No, probably not. But then there's also boutique hotels. Like my first one's a 22 room.
Right. So I think
that's a
like
couple
that's kind
million.
of your model, right? Is
Yeah,
these
boutiques
and then aggregate
And mid-size
them.
maybe.
Yeah.
Yeah, that's kind of what I want to do is acquire, a dozen smaller size boutique
You
hotels.
could do that with $75 million
Yeah.
for sure.
Yeah. Or what's the minimum?
No minimum, but again, when you're paying
Expense.
50 grand, you're going to want to make
You
sure
want
you
a
have
decent fund.
make it
Yeah.
worth it.
Yeah.
Yeah, I see. But it could be a 50 million or whatever.
Yeah.
Yeah, gotcha.
But the max is 75 in 12 months.
Correct.
Yeah.
Okay.
And if you raise 75 in July 2023, you could raise another 75 in August 2024.
Okay.
So the idea here where this might make sense is, and we're using kind of me as a case study, is I bought this hotel in Puerto Rico. I told Veena, I don't want just one, I want a bunch.
Yes.
And so she said, okay, well, the right type of fund could allow you to then go out and acquire
all of them.
multiple hotels.
Yeah.
Versus trying to figure out how to capitalize every deal that comes your way one at a time. It's more challenging that way.
And I would say just as on the operational side, not so much the legal side, like practically, starting with a Reg A is not really going to be great because you're not going to have the company infrastructure to handle all of the requirements of the SEC with having a Reg A because you have to audit, you have to use certain like platforms, you have to have certain verification processes.
And you're hitting on one of the big things is because it's like going public, you typically need to have a track record, a history.
Yeah.
And if
Lots
you
of
weren't,
experience.
Yeah.
So-
and if you weren't keeping those records, which a lot of people are not because they're not thinking about that initially, then it's going to be much more difficult for you to get ultimately qualified to
Because
do it.
remember, we talked in the last video about, family offices who they want to do $5 and $10 million chunks, checks at a time. And so they're going to be looking very heavily at you as an operator.
Right.
I'm not giving you $10 million unless you really know what you're doing.
Right. Yeah. I mean, it's smart money.
Yeah.
Right. They're very smart money.
But I want to reiterate, if you're listening to this, you're like $75 million fund, like where's that even coming from? Again, there are people looking to put their money into something every single day. It's sitting, not doing anything.
Yep.
They need investment vehicles.
Yep. And we're going to go into in later videos about how to find those investors, how to talk to them, what to say. So don't get overwhelmed saying like, oh, I don't know people with this kind of money. You do.
You have an avatar video that we're going to do to find the right type
investor.
of
Yep.
class of money and
Absolutely.
all that. Okay, good. So then if it's not Reg A, what's maybe more ideal?
Let's talk about Reg CF. This is one that might be used and it's a good beginner.
So it's called Regulation CF?
Yeah.
CF for crowdfunding.
Crowdfunding.
Yes. So tell us about what a Reg CF is.
So Reg CF has changed in maybe the last 18 months or so. It's been a while, because when it started out, you could only raise $1,070,000 in a 12-month period. And so many times I'd walk through it with clients and I'd tell them you're capped at $1,070,000, and they say, no, that's not enough, especially with all the work that you've got to go through to set it up. Now they've increased the raise to $5 million in a 12-month period. And so now with many clients, they say, okay, that's a little bit more wiggle room, and we've got enough that we can make it make sense. Now, one of the beautiful things about Reg CF is that you can raise up to $5 million in a 12-month period, and you can raise from anybody. And so we'll talk later about what accredited and sophisticated investors are.
We have a whole video on that.
Yeah. But with Reg CF, you can raise capital from anybody, accredited, sophisticated, unaccredited. The only limitations would be is that if they're not accredited, then they might be capped on how much they can raise or how much they can invest.
And does the fund say when you can start to deploy that money, or do you need to raise the full $5 million in that example?
Excellent question. So with Reg CF, one of the things that makes it sometimes more difficult is that you must set what your minimum raise is going to be and your maximum, and you also have to set a deadline. And if you don't meet that deadline or meet the minimum by that deadline, then all of the money has to go back. And all of the money that you paid to set it up is spent. Gone.
Wait, I didn't know that. So there's a minimum?
Yeah.
Can you set the minimum at like $100,000?
You can, but you want to make sure that you're setting a minimum to where you can still meet the objectives of your deal, because you don't want to take their money and have 100 when you needed 500 to actually make a profit.
Okay, so you can't use like an arbitrarily low number to try to get the deal to actually like work.
Correct. So I'll use you for instance. Let's say that you are doing a value add deal.
Yeah.
And you want to do certain finishes. And you're like, if I do these finishes, it's going to cost me 20 grand a unit, but I could still achieve my goals with a $10,000 a unit renovation. There you could change your numbers and say, look, if we hit this minimum, that'll let us develop it and renovate it to the low level. If we hit the maximum, we can do everything we dream of, but you don't want to go below that, because then you're saying, now I can't renovate those units like I wanted to.
Oh my gosh, I did not know that about Reg CF, because I've never done one. Because my deals, I need more than $5 million. So
you're
it's
doing
just
bigger
not
funds. Yeah.
But
that's much more applicable to people maybe watching this as a start. Like for me, I could go maybe do 1 or 2 deals with a fund like that. So maybe that's a little light for what I want to do with hotels, but you could see where that's now a lot more bite size to get going in fundraising.
Yes. Okay. Tell us about the cost and time to set up a Reg CF.
Before that, one other thing to keep in mind with Reg CF is that you must host your offering on an SEC approved platform. So in the multifamily world, a lot of people now are moving to these platforms. It's kind of nice. It's kind of to where if you think about any investment account you have where you can log in and see your positions, the platforms do a similar thing to where you can log in, you can see your returns, get your tax documents, things like that. So
this is for the investors.
Yes. Like a portal. It's like if you log into like chase.com or bankofamerica.com and you see all your accounts and stuff like that. It's similar.
Okay.
Yeah. So
that's a requirement.
For Reg CF, yes. In the multifamily world, a lot of people just do it because it's nice. But with Reg CF, you're required to have a platform, and it's not just any one. There's about 45 or so that are SEC approved, and it must be one of those platforms.
Okay. And it's like a subscription or something, or like how do you get on there? You just...
You pay for the software. It's a software license.
Essentially. Okay. So that made me think about that when you're asking about costs, because that's one cost that you're going to take on. Typically, they'll have some sort of flat rate, usually not a whole lot more than $10,000, a flat rate up front. And then they also often will take a success fee. So that's one thing you want to keep in mind, and particularly with your underwriting, because they might take a 5% success fee, and that's 5% of your potential returns gone.
That's
so you
like
want to
a
make
commission.
sure you've accounted for that.
Okay.
Yeah, like a commission. So like if I have you invest $100,000, I actually am only going to get $95,000 of it because I'm going to pay that other $5,000 to the portal. So when you're underwriting or when you're modeling it, if I need $100,000 for my deal, I actually need to raise $105,000
to pay the fee.
Yeah. 105.5 or whatever.
And by the way, maybe we should have said this in the very beginning. Disclaimer: Nick is a lawyer, but this is as of right now this recording.
Yes.
So if you watch this,
he's not your attorney,
right? That's true. But why I want to say that is because if you're watching this video, a year from when we record it, things could change. Laws change. So you can't just take exactly what's being said right now on this video as forever and always.
That's a good point.
Because as you know, your job is to stay up on the laws as they
Yes.
constantly evolve and change.
Exactly.
Yeah.
Take this as a nugget and kind of a red flag so you can say, wait, I remember something about that. Let me now go talk with my attorney to look at my unique situation
Yeah.
about this.
Yeah, very good.
Because there's a lot of nuance, and we're going to show you guys a little bit of the nuance here, but then
And
we're going to...
can we put your information in the description below?
Absolutely.
Okay.
Love
so
it.
Veena doesn't have an exclusive on you. Like she doesn't own you, Nick. Like
Not yet. She's
I'd like
trying
to.
to.
I'd like to. Yeah. I mean, I'm so scared because I feel like he's been like the best kept secret in capital raising.
Yeah. Maybe we won't put his
And
information.
I know, right? And I'm like, I've told him though that you can never be too busy to take my call. That's like the rule.
That's what happens, right?
Yeah,
I have
well-
an amazing contractor. I refer him, and now he's too busy for me.
Yeah. It's the worst. It's like this with tax strategy and
Yeah.
lawyers. Like, because how many...
He won't forget the hand that feeds him, though.
He better
Never.
not.
Or
He
that-
better
I got
not.
you, yeah.
Or else I'm going to come find him.
So if you get a response from Mick that says, "Well, hold on, let me check with Veena before I
Yes.
talk to you," then you'll know.
Can you make that your autoresponder
my
on your
auto-
email?
that's my
I love
out-of-office
this.
response.
I love this. I love where we're going with this conversation.
No, but the point here, though, guys, is that you want to stay on top
Yes.
of these things, and there's no way you could possibly do it. I don't know about you, but you don't want to read a 1,000-page thing that the IRS puts out or whoever, right? But Nick does. He actually likes to read those things.
Weirdo.
Yeah.
I mean,
weird,
more
yes.
importantly, you don't want the liability of being the one to have read that. Let him do it. He has malpractice insurance. Let's make them earn their premium.
That's right. Awesome.
So yeah. So
What else
okay.
do we need to know about a Reg CF?
So Reg CF costs.
Yeah.
We talked about you're going to have a flat rate of a few $1,000s up front, plus a success fee to your platform, the platform provider. Your legal costs can range, probably looking anywhere from 10 to 20,
what I've
25,000
Yeah.
for that. And then timing, you're probably looking around 3 months at the very quickest. 4 to 5 is probably the more common.
Okay.
Because you'll have about
Faster.
a month and a half, 2 months of your attorney and their team working with everything. Then you've got to deal with the platform and an escrow company, and they're going to be doing some background checks and reviewing documents. And so usually if it's about 3 to 4 months is about your timeline.
For me, doing hotels, would that be a good fund for that?
Potentially.
Okay.
I think Nick wants to
Yeah.
say it depends. The
Nick always
favorite
says it
answer of every attorney on the face of
It's
the
like
planet.
the biggest escape clause.
It
ever.
is. It's like, do you even know anything about law? If everything's like, it depends. Like that means it's just like you're hedging your bet.
Do they say that so that you'll pay a retainer?
I think so. I think so, actually. Is that what you guys do?
We say that so that we can then bill you for
and back
figuring out what it depends upon.
Do they teach you this in law school?
But in all honesty, it always depends because there's all the nuances about what you're
Yeah.
doing.
Very
right?
nuanced.
Yeah.
Yes.
And one small fact can completely change the advice
Right.
of what you would get.
Yeah.
So, okay. So what was the total cost we decided for Reg CF to be set up? Like 50,
I'd say probably 25.
including legal fees? He's
Okay,
like, oh,
maybe
wait, no,
50.
no, it depends
maybe-
now.
No, now that I think about it, with the portal as well, you might be getting close to 50. You could
Okay.
do it for shouldn't be doing it for more than 50. I'd
Okay.
say that.
Okay. So under 50K, 3 to 5 months to set up. And a lot of it too depends on how quickly they get you information, because then you have to take that and make revisions and go back and forth.
And actually, I'll give a tip. So one thing that you can help with that timeline is really understanding what your deal is. What are your objectives? What's your business plan? Because
Clarity.
Yeah.
A lot of times the thing that slows us up is that we're asking for the client for information and they either don't really know or they're just slow to get that to us. And so if you're slow responding to us, then that's just going to add more to your
Yeah,
timeline.
you can't say, hey, I just want $10 million to do deals. That ain't going to work.
Yeah.
Right.
Gosh, wouldn't that be so great if we could just say that?
Yeah, wouldn't it?
And if someone would actually just give it to you.
Yeah, I'll let you know when I find the
Yeah,
deal,
let
what it's
me-
going to be
yeah.
used for.
Right.
Yeah, but that's still fairly expensive, isn't it? Like
Yes.
to raise $5 million
Yes.
and spend $50,000 to set up the fund.
It's a lot.
And,
Now-
and kind of a long timeline again for real estate as
Yes.
well.
Yeah.
But the one thing I think is important for people to know and understand is the $50,000 is not just out of pocket. You can charge that expense to the fund. So you can raise the $50,000 from investors. Again, you want to underwrite for it and you want to plan for that money, but you can raise it. So the fund can actually pay its own expense. The Reg CF can pay its own
That's going to
expense.
hurt your returns now, right?
It will
that's
slightly.
Slightly, okay.
But it also, again, if you know it, for me, it's not a problem when I go into a deal if there's like a $10 million plumbing issue. The issue is if I don't know about it ahead of time. If I know about it, I can underwrite for it, I can plan for it. And underwriting is just a fancy way of saying model for it, right? Like I can do the math on it to say, okay, if I know I have to spend $10 million on plumbing, then I need to pay $10 million less for the asset than I would have paid if there wasn't a plumbing issue. So it's not the expenses that you know about that are an issue. It's the expenses you don't know about that are an issue.
So let me ask you this question then. Let's take me again as an example. In Puerto Rico, let's say that I want to go buy a bunch of hotels and I want to do a $25 million fund. How important is it that I personally put a big chunk of money into the fund to attract investors? Is that something that's
a good question.
Almost required or no?
Not required.
Okay.
So
but looks good?
It looks great. I mean, think about it. We co-invest with our investors in all of our deals. We sit in the same share classes that our investors can also sit in. When I go to an investor and I say, hey, write me a check for $100,000, I have $7 million in the deal. They're like, oh.
You got skin.
Okay.
I mean, isn't that all lending? Like you buy a house, the bank wants you to have skin. I go get hard money, they want me to have skin. Skin meaning you've got something on the line here.
Yeah, other than just sweat equity and reputation. For me, I actually don't care about the money as much as I care about the reputational hit I would take.
Yeah,
so
because you're thinking long term.
Yeah, that's way more important than any dollar I'll ever put into a deal.
But in the beginning, let's say it's your first fund.
Yep.
And you're like, hey, I'm raising $25 million and I got none of my money in the deal. Is that going to hurt your ability to raise money?
I think it will definitely make it harder. I don't think it's impossible because the first deal I did, I can't remember. I think I put like $50,000 into it.
In the 1.2?
Yeah, in the 1.2 million. I think I put in 50, maybe it was like 30. I can't remember. But it was definitely not a lot because I just didn't have the money, quite frankly. Like, I was poor.
But if you put in $250,000, would it have been a cakewalk to raise the money?
I don't think it would have been a cakewalk because I was missing a lot of the fundamental things that I needed to know to raise capital that we're actually going to do here. So if that hurdle was gone for me, I think it would have been significantly easier. The thing
would you recommend for me if I did a $25 million fund that I put in
yes,
$1 million or
if you have the cash, yes. The other thing that you can do, and we'll talk a lot about this in the more strategic videos that we do, but the other thing that you can do is you can put in what I like to call aligned capital. So I think about that like your best friends, your parents, your in-laws, your cousins, your sisters, like the people that you have to see at Thanksgiving. I consider that aligned capital where it's like, you're really going to be careful if that capital's in there because you can't run away from it.
I did a deal with a family member and it was very clear about, what the gains were and the potential losses were. And I ended up paying, it didn't work out well. And I ended up paying him all because I got to sit at the dinner table with him.
It gets awkward fast, right?
So
like it's really awkward fast.
So he got paid back in full and I ate all the loss.
And you're like, oh.
Yeah.
And now that family member's like, Jerry, take my money again. This is a great return.
Yeah, that's right. Yeah, exactly.
So, but that's the thing is, so you want to also look at if you don't have the money to put in, like I didn't, and a lot of people don't. I mean, you're in a different position today. So I would say for your deal, yes, I would invest capital and I would invest the first capital, but I would also be looking to who you can align with so you can have what's called like an anchor investor, right? So maybe you come to me and you're like, hey, Veena, I need you to invest into this deal because now it's a springboard for you to go out and talk to other investors and say, hey, Veena Jetti, she has transacted over $1 billion and she's put money into the deal.
Because is it true that the first money in is the hardest money in, right? Because if you're like, well, man, they already raised 15 million. Yeah, I'll throw 5 in.
It's because it's
versus,
now proof of
hey,
concept.
You're the first one in. You want to be the first 5 million into this fund.
Exactly. It's harder to do. Yeah. And so there's more perceived risk, even though practically there might not be.
Yeah.
It's perceived. And so, yes, absolutely. The first money in is the hardest money in.
But you also told me, I've got my own hotel now. So that could be the first deal funded, right?
It should be.
And so that's also another benefit to the fund, right?
Right. But a lot of people starting out are not going to have a first deal that they can put into a fund or into a syndicated model, right? And so just know that if you're not starting where Jerry is, that's okay. He's actually late to the game, quite frankly.
Yeah.
Like, you should have been doing this years ago.
Me.
Yeah, you should have been doing this years ago. You've left so much money on the table. You're going to be crying by the end of this video
stop.
series.
Rub it in more, please.
I know.
Stop.
What were you thinking, Jerry?
You're like kicking me while I'm down.
I know. And then I'm like taking the knife and twisting it from
appreciate
behind.
that.
But you know what, though? It's a learning lesson for the people that are listening.
Yeah.
That are not where Jerry is today and should be thinking like this now versus late. But you know what? The best time to plant a tree was 20 years ago. Second best time?
Right now.
Today.
Right now.
So that's what we're getting you done. We're planting a tree for you right now.
Thank you. So Nick, other than the Reg CF, what might be another? Are those the two main funds that people think about?
No, those are the two less used ones because of all of the hurdles and expense and time that it takes. There's actually another regulation that has two parts to it. So these are number 3 and 4 that are wildly more useful.
Much better.
And they're the only ones I've used.
So far, we've just been building up the anticipation in this video.
That, and also we're getting the stuff out of the way because like I feel like a lot of people who are newer to this space talk about Reg CF and Reg A.
You hear about those popularly
so
a whole lot
much. And I'm like, why are you even talking about this? But it's because like some guru somewhere said it because they learned about it or they used it. But it's not actually practical for most people to use either of those two. And quite frankly, there's better potential exemptions for the types of raises that people listening to this and you too. I don't think those are either of those are the right fit for you from a operational standpoint.
So
you tell them from a legal standpoint, but I'll tell them from the operational practicalities.
Okay, so what is it? What's the first one?
All right, we need like a drum roll for these because these are the exciting ones.
So they all fall under Regulation D.
Reg D.
D like David.
So Regulation D. So Veena actually said it's 2. It's actually one exemption that has 2 subparts.
Yeah.
So Regulation D has 2 subparts that are very great for real estate, and it's probably 90% of what we do for clients. And so underneath Regulation D, you have 2 sections. One is called 506B as in boy, and the other is 506C as in cat.
Yes.
And so those are 2 that work very well for real estate.
Do they skip the Reg D and just say 506 B and C?
Yes.
Yeah, that was the technical way you'd say it is typically you'd say Regulation D, section 506 B or 506C. But yeah,
I thought it was Rule 506B.
it might be Regulation D, Rule 506.
Okay, you need to deduct that from your bill.
I'll take 0.2 off the bill.
Let's put that on the screen. So Reg D 506B is the first one we're talking about.
Yes.
Okay.
And this is the most common exemption used in real estate.
It is, yes, by far.
So, yeah.
For private security offerings.
Yes. Okay.
So with 506B, you're allowed to have up to 35 what we call sophisticated investors, and we'll talk about what that is in and out. 35 sophisticated investors and an unlimited number of accredited investors. With that also, you can raise an unlimited amount of capital. So far, I feel like I'm sounding good for you.
Yes.
You're going to need to define those things.
We will. We're going to have a whole separate video because it's a lot of nuance and we want to make sure that everyone really understands.
Yeah.
So there's another video. Look for the other video that's accredited versus unaccredited versus sophisticated so that you can
For now,
understand
that's not
those
the point.
things. Yeah, that's not the point right now.
So 35 unaccredited, unlimited accredited. You can raise an unlimited amount of capital. And essentially, you can start raising as quickly as you and your attorney team put everything together. So for us, typically it's about 4 to 6 weeks. So you're looking about a month and a half, 2 months, and you can start raising millions and millions if you need that. Now, the big thing to keep in mind with 506B is that you must have what's called a pre-existing substantial relationship with all investors. So pre-existing substantial relationship.
What about a YouTube subscriber?
Most likely not. So that would be pre-existing. So pre-existing means that you had to have known them and had that relationship before the deal is on the table. So before you're under contract.
But if they've watched thousands of hours of my videos, I mean, they know me better than anybody else.
So they have a relationship with you. You don't have the relationship with them.
Oh, shoot.
And up to his point, though, we could even make an argument that the relationship is pre-existing, but we've got to go to the next part that says it must be substantial. And that's where you'd have an issue.
Thousands of hours is substantial.
That's a lot. That's a big portion of your life.
But this can be a gray area that you got to be careful of, right?
Yes.
It's one you want to walk very closely because, it's very easy to get it wrong.
So I'm your subscriber. I subscribe to your channel. We have a pre-existing substantial relationship. So you could raise that capital from me. But Susie Smith, who's watching your videos, you have no idea who she is, what she does, where she lives, anything about her. Probably not substantial.
But I just met you in person. I mean, I've known of you and we've text and stuff, but now I've spent this whole week hanging out with you.
Yes.
Would that count?
Yes.
Does that count?
So the substantial part essentially is...
I mean, you knocked me off my tube on my boat.
I broke your boat.
Almost killed me.
I broke your boat.
Does that count as substantial?
I know all of your kids' names now.
No,
all
you
of their
don't.
birthdays.
Impressive.
You do not.
No, I don't. But I know a lot of them. I know you have a list. He has a list. No, but I know a lot of them. At least 50%, I think I can name, which is like pretty good.
So, but how do you define substantial?
So some way to think about it is that you understand the types of investments that she made. You understand her financial situation. You understand her financial background, her educational background. So you're understanding, how financially savvy she is, as well as her general financial position. So it's more than just I've met you or I watch your videos. I know about you, about your finances, about how you look at money, that sort of thing.
Yeah, and you could do anything until you get busted, right?
Sure, yeah.
But
like you could rob banks,
yeah,
but if you get caught, it's a problem.
Yeah, it's when you get caught that's
Right.
the problem. But the point here, though, is if there were an audit, they're going to look at these things.
Yes.
They're going to look at this and say, prove to me that you have a substantial relationship.
Yes.
Exactly. And you hit on a good point because I actually jokingly tell clients, they probably don't laugh so much, but I say, you're going to pay me a whole lot of money. We're going to make all these long, boring, scary documents. And then we're going to hope that we put them in a file somewhere and never look at them.
Right.
Because you only need them if something's going wrong. If something is going wrong, we're glad we have them. But most of the time things don't go wrong. And it's like, that looks like it was a waste. But if you ever needed it, you would really, really need it.
But that's what I love about you, Veena, is you preach from the pulpit, do things the right way.
It's
That's
so much
good.
easier. It's so much easier. And honestly, you'll sleep better at night. Just trust me on this. Like, there are already going to be a lot of sleepless nights when you're doing deals and when you're adding zeros. You will have plenty of things to stress about. Do not make this one of them.
Well, I mean, all the money in the world doesn't really mean much if you're in jail.
No, it doesn't.
doesn't
It
mean a
does
whole
not.
lot.
Yes. I mean, and I have a question about the pre-existing substantive relationship because I actually don't know this. So, and when we started with 506B raises. So my $1.2 million raise that I had to do was a 506B raise. So when we say pre-existing substantive, is it possible for, like, let's say I have someone that works for me, like a sales team or an acquisition team or something like that. Can they have the pre-existing substantive relationship, or is it only me as the owner of the company or the sponsor of the deal?
I'd say it probably depends also upon what their
Shocking.
role is.
Shocking.
I didn't stop at depends. It depends on what their role is.
Okay.
So, just an employee, a rank and file, probably not. Somebody who's in the meeting making decisions, or at least in the conversation,
The
making
executive
decisions,
suite, okay.
Probably so.
Oh, interesting. So they don't have to be like an owner or a sponsor to potentially qualify the knowing.
Not absolutely.
Oh, interesting. Okay.
So if like your CFO knows a family
Right.
fund or something and they
Right.
they bring them in,
Yeah. Okay, cool.
maybe that counts.
That's actually really wildly helpful. I wish I would have known that. I would have hired some employees to
But
solve
again,
my
this
problem.
is why having an attorney, on retainer can
Yes.
help, because you could be, let's say that were a situation. What Veena would do is she would call up Nick and say, "Hey, there's this thing happening right now. Are we in the green?"
Yep.
Right.
Mm-hmm.
And that's
Always.
going to keep your nose clean when you're doing
Yeah,
this.
I actually like to get it in writing so that if there's ever an issue, I can be like, "No, look, my attorney said this," and then pass the blame
but
over
that's
to him.
just smart business. I mean,
Yeah.
we're talking about big deals,
Yeah.
and we're talking about other people's money,
Yeah.
so it matters.
Yep.
Those things
Especially at this point in the market cycle that we're recording this, like we're at the bottom or nearing a bottom of a market and kind of in that bear phase of the market.
Mm-hmm.
So this is the time where, interestingly, more money is made in this, like more millionaires and billionaires will emerge in this part of the market cycle than the last part.
matter. Because while everyone's sitting the sidelines, you're aggressively
Exactly.
buying deeper.
There's so much more opportunity now. But the problem is, this is also where more money will be lost. And investors are going to get hurt. So investors have to really be invested with the right sponsor, They have to really know that the people that are doing this and taking their money are not cutting corners. And that's what I love about having a securities attorney out of the gate is it's instant credibility.
Yeah. Well, it's like you told me, I'm a hotel expert because I've been staying in hotels for years.
I mean, yeah, we did spin doctor that a little bit. He's been familiar with the Hilton and Marriott brand for 25 years.
That's right. But going back to that 506B, so again, 35, what was the 35, minimum 35?
Sophisticated.
35 sophisticated investors.
Not minimum, maximum 35 sophisticated, but
maximum,
unaccredited.
not minimum. Okay, so it could be one.
Correct.
Yeah, or
Up
none.
to 35.
Yeah.
Unlimited on the
Accredited.
Well, again, if you don't know what that means,
Yes, we're
it's
gonna,
okay.
we're gonna, yeah.
Stay tuned. We're gonna really dive into those because it's important.
Yes.
And then no limit on the
Unlimited
size.
raise.
But do you have to define the fund size in the initial fund offering?
Yes, you do.
Okay.
But you would define how much you want to raise. You typically can have the leeway to change that.
Okay.
You also are not stuck on a set date to where you got to raise this minimum by this date.
Oh,
so you
and
have
there's no
much
minimum.
more flexibility.
There's not a minimum
There's no
to
minimum.
deploy into deals?
Correct. There's no legal minimum that you have to accept from
Lots of
investors. There's no
flexibility.
legal minimum
Lots
you
more
have to
flexibility.
raise.
Okay, but the big con of the 506B raise is the pre-existing substantive relationship. So that means if everybody in your circle has already said no, you can't go out and meet a new investor and then raise capital from that
Because the fund's already been created.
because the offer's already on the
based
table.
on the date the fund is set up.
Yes,
that-
the date, if we're talking about a fund, yes. Or if we're talking about a deal, it's the date when you're in the LOI or under contract.
Yeah.
So it's like pretty early on that you start disqualifying new relationships, which also is why it's so important to have a very large network because your top of funnel has to be really wide so that you can trickle down. You know, my first deal case, 1.2 million, my funnel wasn't wide enough for me to do it easily. Today it is, but it wasn't back then.
Yeah, you knew a handful of doctors or whatever.
Yeah, right, exactly. I was like begging all of the people I knew for money, right? And no one wanted to give me money. So
That could be a challenge. I could see that.
and
definitely.
the other drawback or con of a 506B is you cannot generally solicit with it, right? So I can't go on your YouTube channel and be like, hey, I have this deal, come invest with me. I can't induce an investment by posting on social media or, you know, saying like, hey, let me speak at a conference that you are throwing in Puerto Rico. Let me come speak to everybody and pitch my deal. I can't do that.
And the reason for that, again, is because you wouldn't have a pre-existing relationship with those people.
But what if I did this? So we're trying to plan a trip out in a couple weeks.
Yeah.
We're inviting money. What if they came out and I don't have a fund set up?
Mm-hmm.
What if they all came out and I said, hey, here's my hotel. Here's another one I'm looking at. I'm
Mm-hmm.
thinking about raising money for this. Are you interested? Am I creating a relationship and then later set up the fund? And that's kind of my initial relationship building meeting.
Yeah, we'd want to look at the particulars of how you're doing that. But yeah, there's a way you could do that to where you're not soliciting anything, but instead you're building a relationship for the future one.
Okay.
That's smart then, isn't it? I mean, that's
it's
a great
smart,
idea.
But that's because you don't know about 506C
Yeah, we've got
yet.
better stuff.
We saved the best one for last.
All right.
So, okay, here's the reason why 506B is usually what most private money is raised with, right? Like private equity is raised typically in real estate under 506B is because when you first start out, you don't have a track record. You don't have a history. Now, Jerry Norton does. People know who Jerry Norton is. So you're in a little bit of a different boat, but people that are watching this that are just starting out, the vast majority of you, it's likely going to be a 506B that's the best fit for what you're trying to do and check all the boxes you need because your friends and family, the people you know, the people that are already in your network, like that you maybe even are acquaintances with, but you know them. Like
You go to church.
Yeah, I was gonna say your church friends, your PTA friends, your golf buddies, all of those are people that are likely going to be your first investors into your deal. Right? So the best one for you, in my opinion, my non-legal opinion.
I agree.
Oh, that was a definitive yes.
That wasn't a
It was
depends.
not an it depends. Okay,
was
so
no
we're on to
depends.
something here, Jerry. Is Reg D 506C,
C.
like cat, Charlie.
So
Tell us what it
with
is.
that one, you can raise an unlimited amount of capital from an unlimited number of investors. The only qualification is that all your investors, every single one of them, must be accredited, which we'll talk about. But with that, you can do general solicitation. So now you can advertise your deal, and as long as you're having 100% accredited investors, then they can invest. You don't have to know them in advance. You could be raising capital. The deal's moving forward. You meet somebody today, they're accredited. They can come into your deal at that point as well.
Which is really cool.
That is really cool. And super teaser, we'll go into it, but basically $1 million net worth, not counting your personal residence, or more than 250,000. 200,000 in
income.
And that's gross, like W-2, or is that
W-2
or taxable income?
So here's the weird thing, right? The SEC changed their definition from, they took out the word net income, right? Or they took out the word gross income.
It's if your W-2 is 200,
that's it.
accredited.
Yeah.
Yeah.
What if you're a business owner though? Like what if you're a real estate professional and you lose money every year?
Yeah.
It gets a little bit more complicated.
Yeah.
And part of it's just working with your accountant
but that person probably meets the million.
That's what happens. They end up meeting the $1 million in net worth.
So, but anyway, that's what an accredited.
Yes.
We'll talk more about it.
Yes, and we'll talk more about it.
But if you're raising money from that person, no limit, no relationship, as much as you want.
You can meet them at any point in the deal cycle.
Wow, that's
a powerful
why
tool.
You're right. You're so right. That is the right one.
I know it is.
Yeah.
I know it's for you.
Yeah.
If you were starting out and you didn't have the Rolodex that I've seen in your phone, then it would be a different story. You know, I would say, look, you're still building, you're still meeting. So before you go out and raise the capital, you need to go and like have as many substantive relationships as possible so that when the deal is on the table, you can go and fish from a large pond.
I mean, it'll never hurt you to have more substantive relationships with people who have money, right?
Right. That doesn't hurt. It's not
never
so
hurts.
bad.
No matter which way you go,
Right.
it never hurts.
Not so bad.
Yeah, you hit on the thing is that many times clients will say, oh, I want to be able to advertise. I want to do this. And I say, well, this is your first deal. People are probably not going to invest in your first deal if they don't know you.
Right.
Yeah.
And so for the people at home that are watching, go start, like we said, build those relationships now so that when you find that deal, those substantive relationships are much broader because your first one is likely to be a 506B if it's going to be successful.
Yeah.
And I mean, and that goes back to putting yourself out there, be loud about what you do. I remember when I first got started, I would document really well my flips. So I would do like these little before and after transition little videos.
I love that.
On my iPhone 4, you know.
You were like the OG of social media.
Before it was a cool thing too much. But I did it because I wanted people to see, oh, look, he bought this house. This is what it looked like before. And oh, he fixed the kitchen. And the idea was, here's someone doing deals. And so that way, when it's time for, hey, do you want to, well, yeah, I've been seeing all the deals you do. It's a credibility thing, right? So I tell people, be really loud on social media so that people see you doing things.
Yeah. And it's intimidating.
At first.
I mean, I'm like very new to the social media game. And I'm like, oh my gosh, this is so.
What if they don't like me?
There's a lot of vulnerability. And it's scary. But I'll tell you, since stepping up my social media game, you know, and it doesn't hurt that I'm around all of these people who are like
who are great at
the best social media people on the face of the planet. But you know, since I've stepped it up, I've seen so many more investors come into my lead pipe or what do you
your
call
world?
it?
Yeah.
I don't know what you call it. Lead
Your
sales
funnel.
pipe, sales funnel. There we go. So I have a lot more investors come in. Now we do 506C raises because I'm in a similar position to you, but also when you're raising $65 million, I might not have that in my network like today because the reality is if you need $65 million, I actually really need like $120 million. And that's how I'm going to raise $65 million because not everybody who has $100,000 or $1 million is going to write me that check. So I need way more reach than 65 million to actually be successful at raising 65 million.
And just kind of hypothetically on a 65 million raise, what's the average size of investment from people?
$178,000.
Okay, so that's people you know that you go to school with, or your kids go to school with, or on the soccer team.
It's
church.
Accessible.
It's
accessible to anybody.
That's not the super rich over there, you know.
No. And I mean, that's excluding, we have like, you know, our 5 million, 3 million, 8 million, like all the multi-million-dollar checks, taking that out, the average check size, 178,000.
Okay. Yeah.
So
that makes it much more bite-sized much
easier
to take on a project.
And when I first started, we took like 25,000 at a time. So my average check size has gone up over time. And that's a KPI I track very closely. A lot of people don't. If you ask 99% of people, what's your average check size? They'd be like, I don't know, like 50, 100, 200,000. I'm like, well, that's a big range.
Yeah.
Between 50 and 200,000. So when you're starting out, you should definitely track that so you know what your average check size is, and your goal should be to increase the average check size because it's much easier administratively to manage and handle.
Well, and it helps you understand your avatar better.
Absolutely.
Too.
Yep.
So
We're going to talk about that.
Nick, can self-directed IRA funds come into that?
Yes.
Okay. Yeah. So guys, I tell people all the time, if you know somebody that's worked corporate America for 10 years or more, they probably have anywhere from $25,000 to $100,000 in an IRA that's sitting there doing nothing.
Yep.
That if you show them, they can quickly and easily self-direct it.
Yep.
Meaning now they have checkbook control, right? Or control over where that money is invested, and they can bring that into your fund.
Absolutely. Yeah, no, totally agree. So I like the 506C because now I can post about it on social media. I can talk about it on a stage. I can go to a conference, a networking event. I can meet new people, the airplane rides, right?
Yeah.
Like I can meet new people and I can tell them about my deal.
I met here at our community camp event we did this week. I met one of our students here that she said, I'm from Puerto Rico. We've been in the States for a while. And I have $275,000 in an IRA, in a Puerto Rico IRA, that if I bring it to the mainland, they're gonna tax the crap out of me. Yeah, they're gonna nail me really hard. So now she's like, I want to deploy it in Puerto Rico, self-direct it and deploy it in Puerto Rico.
Makes sense.
And can I come to your meetup? And so like,
I love that.
Those relationships can be huge.
Absolutely. And you know what? Speaking of Puerto Rico, right? And this is where we're going to be talking a lot about your hotel fund in Puerto Rico. I think one thing that a lot of investors today are missing about Puerto Rico is they think of Puerto Rico as like
They think Costa Rica.
Right, which is not the same.
People
they
say to me all the time,
sound
you live in
similar.
Costa Rica? No, not
quite.
Costa Rica.
Because they miss that Puerto Rico is actually a U.S. territory. Like you don't need a passport if you live in the U.S. or in Puerto Rico to go back and forth from the mainland to Puerto Rico. It's a U.S. territory. It's like Guam, right? Like it's a U.S. territory.
U.S. dollar, no passport.
Yep.
It's an attorney state. So if you guys understand attorney states, that's how they do title and everything. So in some ways, it's very much similar. There are some challenges, right, for sure.
Of course, but that's true of any market.
Yeah.
That's not unique to Puerto Rico. Every market we're in has a challenge. But I think what people miss, that sophisticated money and smart money doesn't miss, is taxes are the largest expense that most people will have in their lifetime. When you're just starting out, your kind of starter income, right? Maybe you're making like $50,000 to $100,000 a year. Your mortgage is probably your largest expense. But very quickly, there comes a point where taxes start outweighing that. And not just a little, by multiples.
A lot.
Right.
I wish more than anything that someone would have sat me down and said, as soon as you start to be relatively successful at this,
yes, it's painful.
Taxes are going to become now a huge priority.
Yes.
And a part of the decisions you make every day is tax strategy.
Right.
I learned that way too late, writing way too many checks to the IRS.
We all did. Right? We all learned that really late.
Yeah.
Like I remember the first year that my husband and I were married, we paid like $200,000 in taxes. And that was like almost half of our total income. And I was like,
how can this be? Yeah.
What just happened? And that's when I discovered real estate and owning real estate. Now, I was working in real estate, but I was working for somebody else. But now being in my own business and being a full-time real estate professional is way more tax efficient. And Puerto Rico is a phenomenal place. A lot of our friends have moved there for tax benefits, just to realize what tax benefits are available in Puerto Rico. And I think that part of it is educating investors.
Yeah.
Right? The everyday average investor, not the billionaire family office that needs the tax, but like the little guy who could benefit from it.
One thing that Veena helped me realize was there's a certain type of client that you go to raise money, where if you can hyper focus on tax benefit, that will be the most attractive thing about your deal.
Not the returns, nothing else. And the best part of it is because it's a U.S. territory, there's still the infrastructure of the U.S. government behind Puerto Rico. And I think that's overlooked a lot when people are thinking about Puerto Rico.
Yeah. And what's cool is you mentioned like there's some tax incentives for, living there and bringing your business there and income wise. But then on top of that, even take that aside, There's a lot of real estate investing incentives, which means you don't have to live there. You don't have to do any of those things. And you still get these benefits for the real estate deal.
Yes. And we're going to talk about that in future videos so that we can really dive down into it and how we would talk to investors about it.
And it matters because now when you're doing an offering, you want to highlight, hey, here's these additional benefits for these investments.
Yep, absolutely. And so I'm actually really excited to dive into that part of it because I love deal structure. That's like something I really enjoy looking at and like seeing how do we put all the pieces of the puzzles together so that it makes a nice clear picture. And so I'm very excited about that.
But what you just said there, Veena, I mean, that's what makes you so unique is because I heard you say when we were hanging out, you said multifamily is just the widget. Like that's not even, I don't even care.
Yeah.
It could be anything.
Any vehicle,
It could be anything. That's just the thing that works really well. It fits well. It's actually being able to structure a deal and bring in capital.
Yes.
That's the genius.
That's
when you know how to do that, game over, right? Because now it doesn't really matter.
World is your oyster.
Yeah. It doesn't really matter if it's a multifamily or an RV park or whatever it is.
Right.
That's the 10% part that's important. That's important, but it's like, no, but putting together, raising the money to do the deal.
Yep.
And I want to, that's my next place to go, Veena, is I want to be a capital structuring genius.
Yes, we're going to do it together. I'm so excited. That's honestly, I have to say, being in these rooms is so powerful. Okay, just the other day, there were like, 25 of us sitting here at your house.
In a circle on the deck.
Amazing view. We're like living in a postcard for this last week, right? That's what I keep saying. I'm like, we're in a postcard. This isn't a backdrop, guys. It's real. Like,
people are going to be like, that's a cool green screen you got.
I know. That's what I've been telling everybody. This is not a green screen. This is real. See, I can move and you still see all of my limbs and everything.
See the boat go by? Yeah.
Right. It's real. But we're sitting in this room and I had this thought and I was like, there's like 200 million plus of net worth sitting in this room right now. How often do people get to be in rooms like that? More when we were at your brother's farm, when we were talking after the dinner, there were like 10 of us there. I mean, how much money did that represent in that room between all of us? $500 million maybe? Yeah,
which is why people were paying thousands of dollars for a day with Veena or hanging out with the Nortons or whatever. Yeah, that's cool. Yeah, that's fun to see.
It's crazy.
Yeah. And it's why you need to get at things like that, right? Right. Okay, so we talked about the 4 big ones.
Yes. So those are the 4
you
major
the best
exemptions.
For last, probably, right? Most flexibility.
Yep.
The best 2 for last. When you're starting out, I think B is probably going to be the one that checks the boxes for most people. For you, for the hotel fund that we're going to be going into more, I think we're talking about a 506C. And we got a definitive yes from the attorney who never says yes or no.
And he heard some of the conversations we've been having.
Yeah,
right?
he's
so
been hanging around.
A little
got
bit.
the context.
Yes. He's been lurking in the background.
Yeah.
So yes. Okay. So I love it. So our next video, what are we talking about? What's an accredited investor?
I think, was that it?
Should be.
Yeah, accredited versus non-accredited.
Yes. Okay, good.
So we're going to deep dive into that because you want to also be very careful of those nuances,
yes.
right?
Yes.
And should we keep Nick in that video? Does
We
he need to
have
be in
to,
that
yeah.
one? Oh, definitely. Okay.
Yeah, 100%.
Good. So guys, again, thank you, Veena.
Yes.
We're going to have some really great resources that Veena's giving away for free.
Yes.
These are things that she probably paid Nick thousands of dollars to make for her that she's giving to you for free. So be sure to check that link. Also, we'll put both Veena and Nick's information below if you want to get in their world, reach out to them. Nick specializes as a securities attorney. So this is his world. He knows it inside and out.
Yes.
So he would be someone, if you're looking to maybe do a fund, you have to get Veena's permission first. But
permission granted. Well, here's the struggle for me is I don't want them to work with the second best either.
Yeah.
Like, why would you not want the best on your team?
True.
So
there you go.
I mean, you are free. I'm gonna like rub the lamp and let the genie out to go. Just a little.
Well, I mean, let's be real. Not all security attorneys are created equal.
No, they are not.
You know what I mean?
No, they are
Just
not.
like everything. So, so we have that there. And guys, we're super excited to continue in this series. We're putting all of these videos into a playlist.
Yes.
And it's very important that you go to that playlist. We'll put the playlist link as well. That will give you the whole suite of this Masterclass series we're doing. We highly recommend that you go in order because it'll be progressive as you go through this. And again, thank you, everybody. Thank you. We'll see you guys on the next video.
All right.